Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hira Dadia. We have with us Mr. George Haber Joseph, CEO and CIO at ITI Mutual Fund, joining in. Welcome to the show, George, and always a pleasure to speak to you and get insights from you. George, overall, if you go to see in terms of the mutual fund data that is indicating right now, what's the sense that you're picking up with regards to where the market sentiment goes firstly?
So people are confused, with regard to the Omicron on one side, US tapering on other side, and also we are seeing a material improvement in the domestic economic cycle also prior to Omicron kicking in. So there is a complete chaos in the minds of people that whether to put money at work or whether to pull out money. It is a complete confused state. If you look at the retail participation, it is one of the highest in history. So that is, some people say that it's dangerous, and you might need to be worried about. But what I can tell you very clearly, Hiral, is this is not the time to worry too much, because we are seeing the earnings growth in Nifty companies after a decade. Right, and 6% CAGR Nifty earnings growth was there in the last decade, and now it is moving towards 20% CAGR kind of situation. And the last 5 quarters, we have witnessed a significant improvement in the Nifty profit growth, and the profits are contributed by companies which have not been contributing for the last 10 years. Right, so that is the most interesting part. Banking sector, capital goods sector, engineering and engineering and real estate sectors, all of them have turned around, and commodities, all of them have turned around and started contributing to the Nifty profits, which is very interesting. It is very different scenario compared to the past. So I am very positive on the economy and positive on the markets from the next 3 to 5 year perspective. Even in the next 1 year, I believe that Nifty will be much higher than where it is today.
Right. So with that view, I mean, how would you differentiate in terms of the active funds versus the passively managed funds currently in terms of returns?
Yeah, for last decade, actually, it was not very kind for active fund managers, because last 10 years, there was a significant deceleration in the growth because of various government reforms kicking in, as well as the business cycle also turning pretty negative. The industrial capital goods cycle turned very negative. Commodities were in negative position. Banking sector also was seeing a lot of NPA issues, and which was the story of the past. 2018, it peaked. The NPA situation peaked in the banking industry. The corporate NPAs peaked and started coming off. And I believe that that cycle is improving, which is very beneficial for the large banks, and especially for the banking sector as a whole. Some of the pockets are still reeling under trouble, like MSMEs, SMEs, and various other segments within the banking sector are facing challenges because they are mostly impacted because of the COVID related problems. But otherwise, large banks which were hitting the headlines for bad reasons in the last decade, all of them have turned around, and that is a big positive news for the Nifty as a whole. So in my view, the sentiment has been very negative in the past, especially in the last 3-4 months. People are confused, but the way to look at is you are having a higher earnings growth trajectory compared to the past, and we are just start of the earnings boom cycle, and generally markets peak out when the earnings peak out. So today is not the time to worry, and you need to ride this wave of earnings growth cycle, and which can take the markets to a different level altogether. Probably when I look at the capital goods companies, engineering companies, utilities companies, the pain period is over, and most of them are getting big orders, and the improvements are clearly visible. I am assuming that the capex cycle. In the last time when I was on the show, also I mentioned very clearly that I will bet on the capex cycle improvement, massively improving from here. We are seeing the signs of cement companies putting new capex, and also the steel companies putting new capex. So the capex cycle story is coming back, and that is the key thought process that you need to keep in mind as a fund manager or as an investor for the next decade.
Right. So currently, overall, if you go to see, as you mentioned, that we are seeing earnings growth for corporate India that's coming in, and on the back of which we can see good amount of earnings expansion as well from here on. So is it right to say that there are several opportunities that we could see in terms of picking sectors and companies that could do well from here on?
Absolutely. That is exactly the point I was highlighting. See the capital goods as a sector, capital goods, engineering, and industrial products as a segment has been reeling under trouble for the last 13 years, right? And now that is coming back to normalcy, and you are going to see significant growth picking up. For multi-baggers will be made in this sector, in my view, which, when I talk to many distributors of mutual funds, on a day-to-day basis, we interact with various mutual fund distributors. They were telling me that, when I told them that we are going to get an approval for a product in infra space, right? We want to launch an infra fund. So people were saying that, don't use the word name infra. People have been beaten black and blue in the last 10 years. So nobody wanted to put money in that fund. So we give some other name for the fund. So that has been the discussion. People have been really badly bruised in the past. So the interest in that sector is very low. That typically happens in the bottom of the cycle, and we will see tremendous amount of opportunities in this space. So I can see many stocks in this capital goods, engineering, and industrial product space becoming multi-baggers in the next decade. So I will be very positively biased towards these stocks. Banking sector, of course, are the beneficiaries of a good economic boom. And, there also you can see some of the large banks, people are discounting, the market caps are very low. Probably those banks can actually materially change the market caps in the coming years. So I'm extremely poised, because there is no need to go to the smaller banks per se at this point in time, because many smaller banks don't have good balance sheets and they're struggling with the NPAs and not a good liability franchise also. So in that way, I think some of the large banks itself can be material return generators in the coming years. And then coming to some of the sectors like auto ancillary. Again, people have lost faith in that sector. It has been a terrible blow that we saw because of semiconductor issues and various things. One after the other. All the shop, the dealers network was closed down because of COVID in the last 2 years. In fact, right, on and off, COVID aata hai, jata hai, and all these things were happening. So actually, the car sales never happened, and plus on top of it, there is an EV push and things like that. So people are again confused in that sector to put money in that sector or not. Actually, the sector is a very nice sector to invest in. And I see a lot of opportunities in that space also, be it in auto OEMs as well as in the, because the growth is going to come back materially and the pent-up demand will be massive. When there is lull growth for many years, suddenly when the growth picks up, it will be material jump in the growth. Real estate sector, the last one, I think again, some of the multi-baggers will be made in that sector. After 10 years, the sector is coming back to normalcy. So all these sectors can be potential winners in the next decade.
Right. So with this, how do you see a market valuation taking into consideration the price to book? Where would you see it? I mean, and how far are we from peak valuations?
Yeah, typically this is the learning of the past. We have done a lot of research. When I joined ITA Mutual Fund, we hired a gentleman from McKinsey also, who was, he's a Bombay IT, and who was working with me. So we have done a lot of research around this to understand, how the valuations work over a period of time, right? How the decade like 2000 to 2010 worked, how the 2010 to 20 was,
Hmm.
right? Now, when we analyzed all these situations of the last 40 years, decade by decade, we analyzed the market situations as well as the sector leaderships, how it panned out. We realized that, the price to book valuation is a very important metric to look at.
Hmm.
But at the same time, it has to be looked at in conjunction with the earnings growth also.
Hmm.
Right. So that is a key learning which we have put in one of our funds called ITA Balanced Advantage Fund. We have put that particular thought process in that fund to allocate money between equity and debt. Now, how that thought process work is basically, you need to think about valuations in conjunction with earnings growth. Now, earnings growth low period, if you are facing, which is the last 10-year period, 6% earnings growth in Nifty, then you have to look at only valuations, right? For you, there is no earnings growth. So only thing in your game in town is valuations. You look at high valuations, typically Nifty price to book peaks out at 3.5 times price to book, trailing price to book, and bottoms out at 1.65 to 1.75 times. Like March 2020, it was 1.65 times after post the crash. And prior to that, December 2017 peak of the market, it was 3.5 times. So 3.5 times price to book, you sell the market. 1.765 times you buy the market. Simple. A lot of money can be made just by doing this. But if you look at the high earnings growth period between 2010 2000 to 2010 period, the infra boom was in the country. During that phase, the price to book valuation didn't stop at 3.5. It went to 6 times price to book. Okay. For typically people looking at only price to book valuation say that 3.5 times price to book both ho gaya, they will go massively wrong if they don't look at earnings growth in conjunction with the price to book valuation. So that is a period which we are going to enter. For my belief is that, 3.5 times price to book at currently it is trading. Probably, 1 year, 3 years down the line, when we look back, you might say that, it was very cheap. Right. So because there will be massive earnings growth compounding, which is going to happen. If I may tell you that next 3 years, Nifty is going to compound at 20% CAGR. Right. Then you might say that, market is very, very cheap because market will be, 20% compounding will be to the tune of, 70%. You will say that market is 70% cheaper then. Right. So if assuming that market doesn't go anywhere in the next 3 years, then the market will become 70% cheaper. So whether to buy or not, and then your answer is in the question itself. Right. For to my mind, it is not the time to sit on the sidelines. Price to book valuation will peak out somewhere like what happened in 2000 to 2010 decade. It will peak out around 6 times price to book. And by the time the earnings growth would have come full throttle. Right. And, after the earnings growth coming in, when the peak valuation happens on that higher earnings growth, that's when you need to be worried about. Because PEG you would have heard of, price to earnings to growth or price to book to growth. When the growth picks up, price to book to growth, will look cheaper and cheaper. Right. So that is where, many times people go wrong on the assumption that, price to book valuation is very high. So I am extremely constructive on the markets. Next 3 to 5 years, you will see a massive bull run in the capital goods, engineering, and all those sectors, including banking sector. You have to pick and choose auto ancillary, and real estate. So these are the domestic cyclical sectors which you need to be overweight on.
Right. And with this, how are you seeing the impact of what the US Fed has come out and said in terms of their statements? How do you think global outlook will impact equity and the currency market? Because clearly there is some clarity now emerging with regards to how they're looking at liquidity, how they want to contain inflation. So do you think there is a possibility? I mean, how do you see the FI movement basis that?
Yeah, so Hiral, you also are aware that, these are all very fluid things. Today I might say something and, tomorrow I will look completely stupid because macro variables are changing day by day based on certain commentaries of the central banks as well as some of the actions, some of the unavoidable actions of Corona and Omicron and things like that. So we need to take this, whatever I'm saying, we have to be taken with a pinch of salt in that regard.
Absolutely.
But as his basis, what I clearly think is that there is liquidity tightening which is already on cards, right? Because globally the inflation is moving up, interest rates will move up. The supply chain disruptions, it might still continue because now Omicron coming in, and it might create more disruptions in the supply chain, which can actually lead to inflationary environment. Crude is moving up, and $85 or so crude per barrel. I don't think the inflation is going to soften in a hurry. For maybe the next second half of 2022, without some base effect and all those things, you might see some cooling off of the inflation. But in a way, you have to assume that interest rates slowly will inch up. Inflation is going to move up, and at the same time, the liquidity is also going to get tightened, which is already a statement given by Fed, and they are talking about the rate hikes. Rate hikes, aayega, nahi aayega, so that is secondary. But we can see that definitely the statements what has come into the public domain, it is clearly suggesting that there is going to be a curtailment of the liquidity. $120 billion monthly buying of bonds they were doing, and they were buying even junk bonds, and now that bond buying is going to stop in February, is a big news in my view, and which has to take into account that liquidity will come down, and which will have impacts on the markets. Now, what we have to think is that the sectors which, like in infrastructure, capital goods, engineering, it has not attracted any money in the last 10 years. That you also will agree. I can also tell you confidently. So their money going out kind of scenario doesn't happen there, right? And banking as a sector has underperformed mainly because of these reasons. Because the money was moving out of that sector. It is highly overowned by the foreign institutional investors. So money was moving out, and it created a problem in that sector. But even though some of the large banks were actually improving their financials, and they were still beaten down because of the FI outflows. So what we have to think is that incrementally, FI outflows might settle down in a 6 months period. And then, again, there is no other destination where they can put in money. Ultimately, money will come back to India, right? For, if India is going to serve, is one of the largest democracy in the world with the highest, good population, good demographics. There is no other country in the world which is providing this kind of situation for investing. For I see huge growth opportunity in India, and India is coming out of the lull period in the earnings cycle also. So money will chase growth, money will chase returns in the markets. For here, money will come back. For maybe 6 months ke liye to problem hoga, but after that, money has to chase India itself.
Absolutely. I think, and that's the right direction to go with as well. Thank you, George, so much for joining us on the show. It's always a pleasure to speak to you and really get good insights from you, which are really different from usually what the world is talking about. Thank you so much. Speak to you soon again, and stay safe.
Thank you, Irel. Nice speaking to you, and it's a pleasure interacting with you all as always.
Thank you.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.